And 2 talks about accounting equation financial position. So we're gonna just go through the examples in learning unit 2. So the main thing is the accounting equation financial position. The logical method of recording transaction by way of accounting equation is used to process transaction data. Transaction may affect assets, equity, or liabilities, generate income, or give rise to expenditure. So my thing is, when they talk about financial position, so financial position, those will be your assets, your liabilities, and equity. So basically these that they've mentioned will affect your financial position. So before we continue with this, I just want to, especially learning unit 2 and 3, we'll be talking about financial position and statement of financial performance in learning unit. Let me just see, 3 we'll talk about, let's see, we'll talk about financial performance. So my question is, have you seen do you know what are annual financial statements? So these are annual financial statements. So I've taken Sasol, this is the listed company, Sasol Limited. So I've taken an example of its financial statements. So basically now when you see this Sasol Limited annual financial statement for the year ended 30 June, you know what that means. So every company has a 12-month financial period. So meaning Sasol's year end is June every year. So June will be the end of their financial year end. So basically this is just an example. So I just want to show you what we're doing now, the financial position on this annual financial statement. What are we looking at? This is, so because this is a listed company, you can see how long is this, how long is their financial statements. So in comparison to smaller companies, this is, the smaller companies would be max, 10, 12 pages. But can you see this one, how many pages is this? So this is a very big company. So I want to show you. So basically, this is the financial performance statement. This is income statement. So income statement is also called also a statement of financial position. So this is where the statement of comprehensive income. So this is where they record their income and expenses. So in income statement will show a company's performance. Did the company make a profit or a loss? That's why in the statement of financial position, they record your income and your expenses. So income and expenses will be recorded in your statement of financial performance, which is the income statement. So I want to show you the statement of financial position. So statement of financial position will be your assets. Can you see here? Will be equity and liabilities. That will be your statement of financial position. So what is the statement of financial position? A statement of financial position is showing as at the 30th of June, what is the state of the company? What is their position? What is the position as at the 30th of June? So for example, if you want to know what was the bank balance of Sasol as at the 30th of June, you can look at the statement of financial position. So let's just look at the bank account on this. So the bank account is normally a current asset. So a current asset, let's just see. Cash, can you see? Cash and cash equivalents. This is the financial position of Sasol as at the 30th of June. is 34739 million. Can you see?
Yes.
And then if you want to see the detail of this, there is a note. We need to go to note 31. Note 31 is gonna give us a summary of what makes up this 34 million.
Okay.
So let's just go to note 31. So there's also notes to the financial statements. So the notes will give you a breakdown of that balance.
Yes.
So let's go note 31. What makes up that cash and cash equivalents? Let's go down.
Sorry, Matilda, while you are for joining late, are you able to make the percentage 100? I see it's on 67.
Oh, okay. It's no,
Yeah.
I can. Morning, Ravela.
Ramavale.
Ramavele. Did I pronounce it correctly?
Ramavale.
I don't know. Am I pronouncing it correctly? Ramavale.
That's better. That's better.
Okay. All right.
Thank you.
So I'm just looking at page, I just want to see the note 31. Here we are. So basically, can you see what makes up that cash? What makes up that cash and cash equivalent? This is it. So they had a positive balance of 34 million and they have a bank overdraft of 645. That makes 34 million. Can you see?
Yes.
So basically, this is an example of the annual financial statements of a company. So as at June, the financial year end, which is this is the balance, the cash that Sasol had at the state. This is the cash that Sasol had as at the 30th of June. So basically now we're going to be looking at learning unit 2 and 3, the financial performance and the financial position. So students who just came in, I want you to be aware that Ramavele, that I've attached last week's class. The link is attached on the chats. I've attached the link, so you can just get it there. So today we're just going through learning unit 2 and 3. So basically now I was just showing you guys what is a financial, the financial position of a business. So I'm going to start with this because the main objective of me doing this, I want you guys to be able to see how we were able to get to the stage. Can you see? Can you see that at the present moment, the main objective now is for you to be able to get to the stage, the statement of financial position. So for us to be able to understand how we got to this, can you see the financials that I've shown you for Sasol? This is it. We now, the main objective now of this is to get to this.
Okay.
And remember, always when you look at the statement of financial position, you're only looking at assets, liabilities, and equity only. When you're looking at a statement of financial position. So let me just go up a bit. Just want for you to have to understand how they go to that statement of financial position. So the first transaction was this: being Goli, a qualified electrician, started a small service business on the 1st of July. So if he started the business on the 1st of July, what is the financial year end of this business?
If he started when? On the 1st of January.
Yes.
1st of January It's supposed to be 1st of January the following year.
What is the end? This is the beginning of the financial period. So this is when the business
end
was
will be
started.
the 30th of December.
31st of December 20.6. Are you with us?
Yes.
What is the 20.6?
So it's just sort of like the year. So this is 2006. So do you understand why the financial year end will be the 31st of December 2006?
No. Why can't it be 2007?
Okay, let me explain that. So every company, all the companies that are, so if now today, Ramavela, you start a company, let's say today,
Yes.
or let's just say you started the company beginning of August.
Yes.
So every company has a 12-month financial period. So that is the reporting period whereby they need to produce annual financial statements.
Okay.
So if now, the 1st of August, you started your own business, Ramavela Traders, that's the name of your business on the 1st of August.
Yes.
Because a company has a 12-month financial period, so August is your first month of trading. August, September, October, November, December, January, February, March, April, May, June, July. End of July will be the end of your financial period.
Okay. Okay.
If I'm gonna make another example. If I start my business, the 1st of March. 1st of March 2022. What is my financial year end?
Whatever, 28th of Feb, the next year?
Yes. Yes. Yes.
I get it.
Okay. So, Mr. Bingwal is a qualified electrician. So he started his business on the 1st of January, and he decided to deposit 40,000 in the entity's bank account to start the business. So the effect of the transaction to the accounting equation is illustrated as follows. So first of all, before we get to the effect of the accounting equation, you need to understand what this transaction means. So definitely when you look at the transaction, double entry principle comes into play. For every debit, there must be a matching credit. So if he started a business. So when a owner starts a business, so he has contributed 40,000 into the business. So if the owner contributed money into their business, that is called capital. So Mr. Bingoli contributed 40,000 into his business. So every time you read a transaction, you as the student, who are you in this transaction? Because you need to record this transaction. In this equation, who are you? So every time when you look at the transaction, you're sitting as the accountant of BS Electrical. So as you're sitting in the as accountant of BS Electrical, you're looking at this at the end of the month of January. You'll be looking at a bank statement. So when you're looking at the bank statement, you're looking at money incoming into the bank statement. You're looking at 40,000. So at that 40,000, the reference there will be written there, Mr. Bingoli Sitole Capital. That is the reference on the bank statement. So at that point, you wanna record a bank reconciliation for the business, but you need to be able to understand where will you allocate the 40,000. So the 40,000 will be allocated to capital and bank. So the two entries are affected by this entry is bank and capital. bank, because money is coming into the business, is coming into the business bank account, which the owner deposited, and also the 40,000 is the capital that the owner contributed to the business. So this is how this will affect your accounting equation. So before we look at that, this is the accounting equation. So we're looking at this. Can you see? So our accounting equation is assets equals to equity plus liability, or equity equals to assets minus liability. So the main objective of this accounting equation is this equation must always balance. Your assets must always equals to equity plus liability. So in this case, when you look at this this example here of Mr. Bingoli, can you see that the transaction balances bank plus 40,000 money coming in equals to capital plus 40,000, and then plus liability 0. The dash means 0, meaning there's nothing. Can you see that the transaction balances? So it's plus 40,000 equals to plus 40,000 plus 0. This is the accounting equation. And after this, the next step would be, after the 40,000, you would need to record this in your general ledger. There should be a general ledger for this 40,000. So the general ledger will be saying bank, debit 40,000, and capital credit 40,000. Are you with me?
Yes, this is the part that I need to understand the most.
Any confusion? Yes. Any confusion that needs clarity?
So far, so good.
Okay, so the first transaction, we just did the first transaction. So we recorded the first transaction. Let me just go up. So this is the transaction that we just did now. We explained that double entry rule says that there should be two accounts. The one should be a debit, the other one should be a credit, and there should be an amount. And then we were able to see that because the owner started a business and contributed 40,000 into the business. And then now we need to record this into the accounting equation. The accounting equation says, because bank is an asset, when an asset increase, you debit. Capital is equity. When equity increases, you credit. So we're putting a plus 40,000 because bank is an asset. When an asset is increasing, in this case, because money is coming into the money is coming into BS Electrical bank account, so it is increasing the money into the bank account. So it's we're gonna put a plus 40,000. It's increasing the bank account, and when an asset decrease, you credit. And then in this case, equity, capital is increasing. That's why you put the plus 40,000. And then this is how we're gonna record this in the general ledger. Let's look. So this is the general ledger. Capital is equity. And when equity increase, you credit. That's why in this general ledger, this 40,000 is being credited. It's credited because this is equity, and when equity increase, you credit with this 40,000. And there, I also want you to look at how the layout of the general ledger account. So basically, it's saying what is the general ledger? A general ledger is a ledger where it records all individual accounts and their balances. and where they come from. So just looking at this general ledger, you need to understand that, oh, for the month of Jan, there was an account called capital, and the capital was contributed when on the 1st of January, and this is this came by money. Money was contributed. The owner contributed 40,000. So this comes from the bank account for 40,000. The same thing for this account, for the bank account. On the 1st of January, money. So bank account, this is the bank account, and bank account increases on the debit side. So a GL account, general ledger account, will always have a debit side and a credit side. And if you're looking at an asset, which is bank account, so in especially now, if I don't know if your learning unit is it hard copy or is it electronic? Are you looking at an electronic copy?
It's the same one you have.
So you don't have a hard copy?
No.
Okay. I need you, if you can, especially when you're studying, add a note on this, just saying if this is an asset. So for you to remember this account, this is an asset. And on the next to this, also add that this is
owner's equity.
Yeah, this is equity. So for you to remember on this, you need to just add a note or something and just say put there and say asset, and then put there on the side of capital, say equity. Because now we're working with a lot of electronics. You guys need to find a way to make notes on this. Are you with me? You need to find a way to just make notes referencing to this, say bank is an asset and asset increases on the debit side. So the question now is, when you're looking at this on your own, you need to understand, when you're looking at this general ledger, why is this general ledger on the debit side? The reason why this bank account, this general ledger is on the debit side is because money was deposited into the business's bank account. And when money comes in the business's bank account, it increases the asset which is bank. That's why the bank account is debited. So let's look at transaction number 2. Transaction number 2 is on the 1st of January, BS Electrical bought toolbox and tools to be used by BC Toll on credit from big builders for 7,000. So looking at this, what is the transaction telling you? Something was bought. So if BS Electrical bought toolbox and tools, you need to decide what is toolbox and tools to BS Electrical. What is toolbox and tools to BS Electricals? So this will come in, this will be useful, especially if you understand the form of business of the company. So because this is because this is BS Electrical and the owner is an electrician. So if he buys toolbox and tools, what is that to the business? So what is toolbox and tools? Toolbox and tools is a toolbox that he'll be using to come to your house, Faith, to come and fix if you've got electrical problems. So this is the toolbox that it'll come with to come and fix. So the question is, what is that to BS Electrical's business? Is it an asset? Is it a liability? What is it?
The tools would be an asset, a way to make money for the business.
Yes, this generates money to the business. So that's why this is an asset. So, and also you need to check, how was this bought? This was bought on credit. So BS Electrical owes Big Builders 7,000. So this is what? A liability.
Liability.
Yes.
So this is a liability. This is money that is owed to Big Builders by BS Electrical. So what are the entries? What are the transactions? What are the accounts? So the accounts would be toolbox and tools, which will form part of the asset, and creditors. A creditor called Big Builders. So if an asset is being bought by the business, is this increasing assets or decreasing asset for BS Electrical?
So the asset will increase.
Yes, because there is additional asset coming into the business.
Yes. Yes.
So we already there that we already know that toolbox and tools is an asset, and the asset is increasing. What about Big Builders? Big Builders is a creditor that is put by BS Electrical. So if now a company incurs a liability, is that liability increasing or decreasing in BS Electrical's business?
The liability increase.
Yes, yes. We are increasing liabilities into the business. So toolbox and asset is increasing. Creditor BS Builders is increasing. How will this affect your accounting equation? How will this affect your accounting equation? So the 7,000, how will it affect? So the 7,000 tools and equipment is what is increasing, plus 7,000. Equity, there's nothing, will be 0. And then your Big Builders creditor is also what? Increasing.
Increasing.
Are we fine with transaction number 2?
Yes.
Let's do transaction number 3. Oh, before we do transaction number 3, I want to show you how the general ledger.
The general ledger, yes.
Yeah, so what do you think the general ledger will look for those two accounts? So the accounts is tools and equipment and Big Builders, the creditor. So let's look at the general ledger. Can you see toolbox and equipment? Because toolbox and equipment is an asset, and an asset, when an asset, debit. Yes, when an asset increase, you debit. That's why it's been debited with 7,000. And also with a creditor called Big Builders. When a liability increases, you credit. That's why it's been credited. And at the end of the day, for every debit, there must be a matching credit. For every debit, there can be in a transaction. One thing that you always need to remember, when you're looking at the transaction, you can never have a transaction whereby there is two debits. Your transaction must always have a debit side and a credit side. You can't now say, we can't say toolbox and equipment debit and also creditors debit. Can you see? We can't. There should be a debit and a credit and an amount. So in this case, the debit is tools and equipment. The credit is Big Builders, which is a creditor, and the amount is for both is 7,000. So the double entry principle says there should be a debit with a matching credit and an amount. An amount is the 7,000. So can you see, this is the general ledger. So let's look at transaction number 3. Transaction number 3. So transaction number 3 is saying, on the 1st of January, BS Electricals bought a ladder from Ladders Pty Ltd and paid it by check for 1,200. So BS Electrical bought a ladder. What is a ladder in BS Electrical's business? What is a ladder?
A ladder would be an asset again.
Yes. Yes. Why are you saying that? You are saying that because he is an electrician. The business is BS Electrical. He would be using this to come and render a service. A ladder will be used to go render a service to a customer. That's why this is an asset. And then paid by check for 1,200. So remember, there must be a matching debit and a credit and amount. And also there must be 2 accounts. So the account is a ladder, which is an asset, and the another account is what? Is bank account. Because this was paid by check. And the amount will be 1,200. So the question is, if a ladder is being bought into the business, is it increasing assets or decreasing assets in BS Electrical's business?
The ladder is increasing the assets.
Yes. And what about
the check payment? The check payment made would decrease the assets by 1,200.
Yes, yes, yes. So in this transaction, the ladder that is bought is increasing the assets. So the assets will increase by 1,200, and the bank, which is an asset, will decrease by 1,200. Because why? Money is going out of the business bank account. That's why this will be decreasing. And when an asset decrease, you credit, and when an asset increase, you debit it in the general ledger and the trial balance. So in this case, how will this affect the accounting equation? Bank account, because bank account is decreasing, you're gonna put a minus 1,200. To a ladder is decreasing by 1,200. You're gonna, a ladder is increasing because it's an asset. A ladder is not decreasing. There is more assets being bought into the business. So when there's more assets being bought into the business, it's gonna be a plus 1,200. Can you see the effect of the equation? Is it balancing? Is this equation balancing?
Yes, it balances.
Minus 200 plus 200 is 0, equals to 0, equals to 0. Can you see?
Yes.
And then let's just look at the general ledger. How will the general ledger look? Let's see. Let's look at the general ledger. Bank account is what? Is decreasing because BS Electrical, the business, bought a ladder for, am I right, for 1,200. Transaction number 3. Transaction number 3. Yes. So the bank account is what? Is decreasing with 1,200. Let me go. It's decreasing with 1,200, and tools and equipment is what? Is also adding, is also increasing. So from initially we bought tools toolbox for 7,000. So initially, BS Electrical only had one asset, which is toolbox, but they bought an additional asset, which is a ladder for 1,200. That's why now tools and equipment has increased from 7,000 to 8,200. Do you understand why I say to 8,200?
Yes.
So it was previously 7,000, now is 8,200. How do I get 8,200? I said 7,000 plus 1,200 to get to 8,200. So let's look at transaction number 4. Transaction number 4, it says on the 1st of January, BS Electrical borrowed 50,000 from Unibank at an interest of 10% per annum for 60 months. The 50,000 was transferred to the bank account of the entity. So on the 1st, BS Electrical borrowed 50,000 from Unibank at an interest of 10% payable over 60 months. The 50,000 was transferred to the bank account of the entity. So can you see what happened now? Liability and asset at the same time. We incurred a liability, we've borrowed money. We've incurred a liability, we borrowed money, and that money that was transferred to a bank account. So liability, because we borrowed money, we're increasing our liabilities. Liability will increase by 50,000 and the bank account will increase by 50,000. How will this affect our accounting equation? Bank account plus money came into a bank account, and then liability, long-term loan has increased by 50,000. Are you with me?
Yes.
So we incurred a liability and also an asset at the same time. So let's just see how the general ledger, how will the general ledger be? So can you see the bank account now, it's debited with 50,000. If an asset increase, you're gonna debit it. If an asset decrease, you're gonna credit that. So in this case, the asset is increasing, money came in a form of BS Electrical went and took out a loan. And long-term loan, the loan is increasing because now BS Electrical has a loan now for 50,000, which is increasing the liability, the long-term liability of BS Electrical. So transaction number 1, let's go back to transaction number 1. Where is it? So transaction number 1, one thing, and assets can be split into current assets and non-current assets. Liabilities can be split into current liabilities and non-current liabilities. So what is a current liability? What is a current asset? A current asset is an asset that is due within 12 months. Non-current asset is an asset that is due longer than 12 months. I'll give you an example. So if I open an account, if I've got a data and a customer. So let's just say Faith BS Electrical come and fix your electrical stuff at your home. So BS, the agreement, so there's a credit agreement that you enter into between you and BS Electrical. So the agreement is, I don't have the money now, but within the next 12 months, I will pay this 20,000, maybe let's say BS Electrical charged you 5,000 Rand. So the credit agreement is saying this money will be due within the next 12 months. So that is a data, that is money that is owed to BS Electrical. And money that is owed to BS Electrical is an asset. And that is because the credit agreement states that this will be paid within the next 12 months. This is a current asset. If BS Electrical now buys a vehicle, they buy an asset. So you can't buy and they enter into a lease agreement, finance lease agreement. So on that finance lease agreement, a car normally is payable within 60 to 72 months. So can you see that when that asset is sitting there, it's an asset, but it's still owing to the bank. You've got the asset in your non-current asset, but it's owing to the bank. You don't have that. So that asset, you don't own it as it is sitting in your non-current asset, because now you have it, you've signed the agreement, but it wasn't bought cash. Are you with me, guys? Are you still there?
Yes.
Are you still there?
Yes, we're still here.
Yes, we're
So
still here.
I want you to see the difference between a current asset is due within 12 months and a non-current is due within longer than 12 months. A current and non-current liability. So in this case, in this example that we're looking at now, BS Electrical in example number 2, BS Electrical bought from Big Builders for 7,000. Big Builders is a current asset because this will be paid within 12 months. But transaction number 4, this is a payable over 60 months. This is payable over 60 months. So this will be called a non-current liability. So I just want to go down here. Let's see. So current assets. So an asset shall be classified as a current asset when it satisfies any of the following criteria. It is expected to be converted into money or is intended for a sale or consumption in the entity's normal operating cycle. It is held primarily for the purpose of being traded. It is expected to be converted into money within 12 months of the statement of a financial position date. So examples of current assets are trade, inventories, consumables, debtors, the example that I just gave you of debtors. Remember that example of debtors? Accrued income, prepaid expense, a positive bank balance, cash flow, and petty cash. Non-current assets are assets, all other assets, that's been assets that are not classified as current assets. Non-current assets include intangible, and financial assets of a long-term nature. It is not the intention of the entity to sell the non-current asset, but to use this asset over a long term in its business. It is held primarily for the purpose of being traded. That is a current asset. And non-current, it is not the intention of the entity to sell the non-current asset, but to use this asset over a long term in its business operations to earn an income. So this is also the example of the ladder. So in this one, a non-current asset, the ladder and the toolbox. So ladder and the toolbox are examples of your non-current assets, because why? Their intention, it is not the intention of the entity to sell this, but to use this assets over a long term in its business operations to earn income. So your ladder in this examples that we did, and your toolbox, those are examples of your non-current asset. So in this example, the current asset will be your bank account. The bank account will be your current asset. The non-current will be your ladder and your toolbox. That will be example of your non-current asset. Current asset here, current liability here will be your creditor, big builders, and the non-current will be that loan, that long-term loan that's over 60 months. Long-term loan, mortgage, and debentures. This is examples. Okay, I will be right back. Who is that? Okay, all right. So the example of let me just see, current asset will be your creditors, your bank overdrafts, current portion of the long-term loan, short-term loan borrowings, accrued expenses, and income received in advance. Example of non-current is that loan, long-term loan, mortgage, and debentures. So guys, do you see the difference between current asset and non-current, current liability and non-current liability?
Yes.
So you need to be able to know that, especially when you're analyzing the annual financial statements. So now we're looking at this annual financial statements. So the question is, how did they get to this 40,000, the 50,000, the 7,000, 8,200, and this balance? So now let's go up. So the assets, so tools and equipment, how did they get to 8,200 for tools and equipment? So every time you look at your statement of financial position, the balances will normally be coming from your trial balance. So those balances will normally come to your trial balance. So let me just see if there's a trial balance here. So I think in this example, they did not do a trial balance. So when you look at a statement of financial position, there would have been, these balances would have came from your trial balance. So these, let me just show you. So these balances would be coming from, let's see, trial balance. Trial balance of BS electrical. Is it so the first account there, let me just go down, let me just go up. So basically a trial balance will only be generated from using what? From the general ledger. So looking at this general ledger, the bank account. So this is the bank account. What is the balance of the bank account? This is the balance of the bank account. So when you do a trial balance, you'll say bank. Let's see the bank account. So at the present moment, what I'm showing you, I want to show you how this trial balance was generated. This trial balance was generated using this general ledger. So how is this general ledger? How is this general ledger how is this general ledger having a balance of 8,800? So I want to show you also how do you balance a general ledger. So basically, when you balance a general ledger, you need to be looking at the bigger side. So when you look at this account, 40,000 came in as a contribution, and then there was 50,000 like a loan that was taken, and the total was 90,000. Tools and equipment was bought by check for 1,200. So do you agree with me that 40 plus 50, 90, the debit side is bigger than the credit side? Are you with me, Faith?
Yes, I am.
So can you see that? So this, I'm showing you how to balance an account. So initially, when you look at this account, the credit side is the bigger side, which will give you 90,000. And then the smaller side, which is the credit side, which only has 1,200. So this means that money into the business was 90,000 in January. And we bought, out of that 90,000, we bought tools and equipment for 1,200. What is left? It's 88,800 into the bank account.
Yes.
So the bank account now is left with 88,800 because why? Tools and equipment was bought.
Was bought, yes.
So this 88,800, this will come here in your trial balance. 88,800 will be 88,800. This will be in your, let's see. This will be in your trial balance. So I'm telling you that before, you cannot do a trial balance before you do a general ledger.
Before you do, okay.
Can you see? Because when
Yes.
where are you getting the balance?
The balance is from, you need to tally up all the monies, then whatever is left next to the trial balance.
Yes, and also I forgot to just add here. Let me add here debit, and let me add here credit.
Okay.
So one thing I want you to notice with this general ledger account, the balance is on which side?
It's on the debit side.
And when you take this balance, where is it? To the trial balance. Where is the balance on the trial balance? It's also on the debit side. Can you see?
Yes.
It's also on the debit side. So whenever an asset increase, and it will increase on the debit side, when you take it to the general ledger, and the trial balance will be on the debit side.
Yes.
So in both the trial balance and the general ledger, it will be on the debit side. So let's look at another transaction, capital. So now we're going to record capital. So the balance of the capital account. So we're looking at this. Can you see?
Mm-hmm.
So the balance, let me just look. So the balance of this capital account, the balance of this capital account is what? Is 40,000. Can you see? And
yes,
this 40,000 is on which side?
It's on the credit side.
So in the
trial balance.
In the trial balance, where am I gonna record this?
On the credit side.
Yes, yes, yes. Can you see? It's gonna be what is it? I think it was 40,000. And then let's look at another account is tools and equipment.
Okay.
Another account is tools and equipment. And tools and equipment is on which side?
It's on the debit side.
It's on the debit side. And we're gonna put it where? Where are we gonna put this?
On the debit.
On the debit side for 8,200.
8,200.
So the main thing is when you do a TB, a trial balance, your trial balance must always balance. So the other account is big builders, is creditors, big builders. So creditors, big builders, what is it? Which side is it?
It's on the credit side.
And when we're gonna put it on the credit side.
On the credit side, 7,000.
And then long-term loan. Another account is long-term loan. And long-term loan is on which side?
Credit.
On long-term loan Unibank.
So we have
long-term loan.
oh, balances.
So your trial balance must always balance.
That's
so 88,800 plus 8,200.
It's 97,000.
And also the same is it 97,000?
97. Yes.
So basically, before you even do your financial statements, you should be, before you do that statement of financial position, you should be looking at the trial balance, taking the figures from this trial balance.
These kids don't.
And then, can you see the statement of financial position?
Yes.
So now you'll be looking at the TB. You'll be looking at the trial balance. The first account is tools and equipment. Can you see tools and equipment is how much? 8,200.
8,200.
You take it from the TB, put 8,200. Current asset, which is this one, which is bank.
Which is the bank.
8,000 comes from the trial balance. Can you see 8,800?
Yes.
So can you see that when you add your current asset and your non-current asset, current assets, how much do you get?
97,000.
Okay, all right. And then when you look at now, I want to show you your equity and liabilities. So capital, your capital account is, from the trial balance, you can see is 40,000. Your non-current assets is 50,000 and your creditors 7,000, all adding up. So this here, can you see that your assets must always equal your equity and liability, which is what?
Equation.
Yes, well done. Yes, which is the accounting equation, which is this. Where is that?
Yes.
Where is the accounting equation? Which is, so at the present moment, this is it. This is this.
Yes.
Because if you look at the I want you to look at this financial post, what is the accounting equation saying to us? It's saying, just want to open this. The accounting equation is saying, accounting equation is saying assets equals to equity plus liability.
Yes.
When you look at this statement of financial position, is that the case?
Yes.
Assets equals to equity plus liability. Is that the case?
Yes.
Can you see what we just did? So when you do the accounting equation, you're basically doing the statement of financial position.
Yes. Yeah, it's so easy to to confuse the assets and liabilities and everything.
It's so true. It's so true. And the trick now is when you're looking, like as you said, to say that you looked at this, but you were confused with the general ledger. But now when somebody goes through this with you, it becomes clearer on what's really happening.
Yes.
Am I lying? It becomes clearer
No,
to say, oh.
It does, because when you try to do it in your own head, it never works. But when you're hearing it from someone else explaining, yeah, it becomes much clearer.
So can you say that assets is this 97,000 total assets minus equity? What is equity? Assets is 97,000 equals to assets plus liability.
Yes.
So assets equals to equity plus equals to
so
equity.
Even if you do it the other way around,
yes.
If we say asset minus liability equals to equity, it should balance.
If you say equity, the other way is equity equals to assets minus liabilities.
Asset minus liability, yes.
So equity, how much is equity?
Equity is 40,000.
Okay. And then
assets is 97.
So 97 minus liabilities.
Minus 40,000.
No. How much is your liabilities?
Oh, sorry, liabilities. Liabilities there?
It's 57,000.
57,000. Oh, yes. 57,000. You see? This is how you get it wrong. So we have 40,000.
Can you see? So
which is your everything.
So when you say, we look at the first transaction, the first, when you look at the first accounting equation, it says assets equals to equity plus liability. So we put in assets, which is 97,000, plus equity, which is 40,000, plus 57,000.
Yes.
So can you see where I get the figures?
Yes.
It balances. When you look at the other one, equity equals to assets minus liabilities. Equity, how much is equity? Equity is 40,000.
40,000.
Equals to 97,000.
Minus 57,000.
Gives you what? 40,000. It also balances.
It also balances.
Can you see? So yes. Basically now we could have, if you wanted to do shortcuts, but especially when you're doing accounting transaction, you can't do shortcuts. You need to follow the process, source documents, after source documents, subsidiary journal, after subsidiary journal, general ledger, after general ledger, trial balance, after trial balance, financial statements.
Financial, yes.
But if this wasn't done according to the accounting cycle, you would have taken the transaction, the first transaction that we looked at. Where is the first transaction? We could have recorded this directly to the financial statements. Because accounting is working with an accounting cycle, that cycle needs to be audited at the end of the financial period. So you can't just take this directly to the financial position. We need to have how to trace our documents. There should be how to trace all the documents. How was it recorded?
Yes.
So now we're going to be looking. Yes.
I was just saying, I think if you get the first entry right, then everything should be fine. If your first entry balances correctly, then every other thing that follows is correct. But if you get the first entry wrong, then it's never. If your first entry, your left doesn't balance to the right, it's
yes. So I understand what you're saying, Faith. If your double entry principle, you didn't understand that, then
yes.
you yeah, everything else when you do it
That
won't
follows is
balance.
wrong.
It's wrong.
Yes.
Everything else is wrong. So I want us to do the financial performance. Let's do the financial performance. So the financial performance, now we're looking at income and expenses, which is part of what? Of equity.
Yes.
So profit or loss for the year equals to income minus expenses. So also these income and expenses, we're going to be using the same principle, the same double entry principle with this income and expenses.
Okay.
So income is profit or income. So profit or income is the increase in economic benefits of an entity during an accounting period, which results in an increase in equity. Such an increase can be the result of an increase in asset or decrease in liability. So these are just examples of what is revenue. Fees and sales, income, rental. These are just examples. Expenses are incurred to earn income. Losses or expenses are debited because it decreases the equity amount owed to the owner of the entity. If equity decreases, the losses or expense account must be debited. So we're going to be looking at this. So remember capital is part of equity. So when capital increase, you credit. When capital decrease, you debit. And then expenses or losses. So when your expense increase, you debit. When your expense decrease, you credit. So expenses are the outflow of economic benefits during the accounting period, which results in a decrease in equity, such as a decrease can be the result of a decrease in assets or increase in liabilities. So these are examples of your expenses and losses. Cost of sales, rental expenses, interest. So these are examples of your expenses. So I want us to do transaction number 5. Mr. Bingole Sitole rendered a service on the 15th of January for cash to clients for the amount of 60,000. So if a company has rendered a service and received money from the client, what accounts are affected there? There's definitely income.
Yeah.
Income.
Okay, so there is.
So there's income. Why? Because he has rendered a service. Remember this, Mr. Bintole is an electrician.
Yes.
So if he comes to your house and fixes your electrical appliances and you pay him money. So in the business point of view, in BS Electrical's books, income has come into the business. Because why? The client has paid. Cash. The client has paid cash.
Yes.
So if the client has paid cash, money has come into the business. So
an asset will be affected.
yes, yes. So the two account will be income, which is service rendered, and bank account.
Oh, okay. Oh, income and
bank account.
Oh, okay.
Bank account because money was paid cash.
Money was paid, yes. Income and bank, okay.
So now, let's just look at how this will affect the accounting equation. Bank increase 60,000 and equity is increasing 60,000. Can you see how it affects? Because both are increasing. Money is coming into the business bank account, and also our income are increasing. So the bank account is increasing, the income service rendered is increasing. So that's why it's a plus 60,000 and plus 60,000. So is our equation balancing?
Yes.
Can you see plus 60,000 assets equals to plus 60,000 equity?
Equity.
And how will the general ledger look? Bank account, can you see? Bank account.
Yeah, the bank accounts will be debited.
Yes, with 60,000. And because it's an asset increase on the debit side. That's why we're debiting it by 60,000, because money came in, service was rendered, and money came in, the client paid cash. That's why bank account asset is increasing by 60,000. Service rendered income will be credited by 60,000. If income is increasing, you're gonna credit income with 60,000.
Okay.
So this is how the general ledger will look. So let's just look at, so we looked at transaction number 5. Transaction number 5. Transaction number 6, Mr. Bingoli rendered a service on the 16th of January on credit to M Beauty for an amount of 20,000.
Okay.
So I want you to look at the difference between the two transactions. So I'm going to just screenshot transaction number 5. I want you to look at the difference between these two transactions. Transaction number 5 and transaction number 6. So look at transaction number 6 and transaction number 5. I want you to look at them together at the same time. Tell me what's the difference between those two?
Okay, so the difference would be the payment method. The transaction number 5 was paid cash, and transaction number 6, the company gained a debtor because the client didn't pay cash. It was work done on credit.
Yes. Can you see the difference? The difference, yes, that's correct, Faith. So the difference is transaction number 5 is a cash transaction. Transaction number 6 is a credit transaction. Transaction number 5, I'm saying it's a cash transaction because service was rendered and cash was paid. After the service was rendered. Transaction number 6, I'm saying is a credit transaction because service was rendered, but on credit. Money was not received after the service was rendered.
Yes.
So the difference between the two transactions is 5 is a cash transaction. It's the two accounts are income and bank. Transaction number 6, the two accounts are income and debtors.
Yes.
So please, 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 guys, be aware of the difference between the two. Transaction number 5 is a cash transaction. And a cash transaction is whereby a service is rendered and cash is received after the service is rendered. Transaction number 6 is a credit transaction. Why is it a credit transaction? It's a credit transaction because service was rendered, but on credit.
On credit.
The amount due to BS Electrical will be paid later. But in transaction number 5, the money service was rendered and money was paid now, was paid after the service was rendered. So that is the difference between a cash transaction and a credit transaction. So we're going to be looking at transaction number 6. So the transaction number 6, the accounts affected is income and debtors. So let's just see how will this affect the accounting equation. So the accounting equation is the asset, the data is increasing by 20,000. Income is increasing. So equity is also increasing by 20,000. Can you see that our equation balances? Plus 20,000 assets equals to plus 20,000 equity. And for liabilities, there's 0. And then when we look at the general ledger account, let's see how the general ledger account looks like. So service rendered, can you see we've got an additional 20,000. This was paid by cash and this was paid on credit. Can you see? This was paid cash and this was paid on credit. So the total income is 80,000. Can you see? 60,000 plus 20,000, the total income is 80,000. Just want to look at the data account. So there is a data called M-Beauty that owes BS Electrical 20,000.
20,000.
Can you see we have a data called M-Beauty that owes BS Electrical 20,000. So because this is an asset, when an asset increase, you debit.
You debit.
Okay, this is transaction. I think that was transaction what number? Was it 5?
6.
Oh, 6. Let's do 7. So transaction number 7. On the 28th of January, business's telephone account for January was paid by check 1,200. So which accounts are affected here?
The bank is I think credited 1,200.
Okay.
And what is that, a minus? And then this is business account, and then what is this? This is the part where I didn't understand one of the questions, to be honest.
Okay, let me
a telephone account. A telephone account would be paid obviously with the money that we're taking out of the bank.
Yes.
But I don't know where it belongs in the equation.
Okay, so on the 28th of January, the business telephone account for January was paid by check. Telephone is an expense.
Yes.
So if telephone is an expense, an expense is increasing. The business is incurring. So for example, so now on the 28th of February, business account for January, they've paid 1,200. So the business has incurred an expense for telephone for 1,200, which is increasing the expenses of the business. Why am I saying this is increasing the expenses of the business? Before this transaction happened, BS Electrical didn't have an expense for telephone. That's why I'm stating that the telephone account is increasing the expenses for BS Electrical. Now BS Electrical has an expense for 1,200.
Okay.
So the two accounts is telephone and bank. The expense
and bank. Okay, no, it makes sense.
The expense telephone is increasing and the bank, the asset is decreasing.
Decreasing. Okay.
So let's see. Let's just see how this will affect your accounting equation. Bank and asset is minus 1,200. It's decreasing. And equity, which is, so equity, an expense will always decrease your equity. That's why it's a minus 1,200.
Okay.
So what is equity? Equity is the return to the owner. So the return meaning the money that is due to the owner, the returns for starting the business. What am I getting for my business? Am I getting my return? Is it a profit or is it a loss?
Okay.
So do you understand when I say if a company has made a profit, that's a good return, good equity for the owner. If a company has made a loss, that's not a good return for the owner for starting his business.
Yes.
So in this case, why am I saying, so can you see that this minus here is decreasing the equity? Because why? It's an expense. Money is coming out. And these two are incomes.
So equity, okay. So equity increases when you credit and it decreases when you debit. So because the telephone account was debited with 1,200, it decreases owner's equity.
Yes. And also always remember when you're dealing with equity, when service is rendered or when there is income coming into the business, that will always increase your equity. When a business pays expenses, those expenses will always decrease equity when you're looking at the accounting equation.
Debit.
I'm going to just repeat that. I'm just going to repeat that. Make a note of that. If a company renders a service or receives income, that income will increase equity when you're doing accounting equation. And when a company pays the expenses, when company pays the expenses, those expenses will decrease equity.
Decrease equity. Now that makes sense. You see, I needed this class.
And you were fortunate that it was like, yeah, it was the attention. It's not a lot of students. Hey, so I think, so now what's important? So hopefully you made a note of what I just said now.
Yes. The
Okay.
company pays an expense, the equity decreases.
So
No,
yes,
this was very important.
yes. So now let's look at the general ledger account. So the general ledger account of that income, of that expense that was paid, which is telephone, the telephone
Which is
account,
telephone.
because it's an expense. When an expense increase, you're gonna debit your general ledger.
Yes.
And then when money comes in out of the business bank account, you're gonna credit with 1,200. So this is how it will affect your general ledger. So we did now transaction number 7. Let's do number 8. On the 31st of January, the receptionist salary for January was paid by check 6,000. What accounts are affected there?
Salary and bank.
Yes. What is salary?
An expense.
Yes. What is bank?
Bank is an asset.
Yes. So the two accounts here is salary and expense and bank and asset. So when a salary is being paid by a company, what is happening? Is the expense increase? What's happening? Is expense increasing or decreasing?
Sorry, when the expense is increasing.
Yes, yes. The company, the expense is increasing because the company is incurring an expense for that month.
Yes.
And bank is decreasing.
Decreasing.
And how will this affect your accounting equation?
Okay, so it's gonna be, we're gonna credit the bank.
Bank is decreasing, you're gonna credit. And what about salaries?
When company pays expenses, equity decreases. So the salary, our expense are gonna. No. Owner's equity is gonna decrease.
Yes. Remember, when a company pays the expense, that expense will decrease the owner's equity.
Yes.
And how will the salary be looking on the general ledger? Because this is an expense. An expense. Okay, so the expense is increasing on the debit side. So it's gonna be on the debit
side.
Yes, and it's gonna be debited with 6,000.
6,000. So it's gonna be salary and debit 6,000.
Yes. And then the bank account.
The bank, we're gonna credit 6,000.
Yes, it will be credited with 6,000.
I needed this part so much. I was struggling by myself because I knew that something was being debited and credited. Now it's so much clearer. I can balance these books with my eyes closed.
That's good. That is good. That is so good. I'm happy. So now we've done all the transactions. Now, as remember the last learning unit, I did trial balance.
Trial balance, yes.
So I can see now this one, they've done a trial balance. Can you see?
Yes.
Can you see they've done a trial balance? So let's just see where they got the amounts. So bank account, they say it's 1. So my question to you is, where do they get those amounts?
From the,
where are these balances coming from?
what did you say? From the general ledger, I don't know.
Yes, yes, yes. You can't do a trial balance without a general ledger. You cannot. So I'm just gonna show you where these are coming from. This is the bank account. Let's just look at the trial balance. So that's 141,600. Can you see where it's coming from?
Yes, they are all the names.
And can you see that on this general ledger, the bank account is on the debit side?
Yes.
And the balance on the trial balance is also on the debit side.
Yes.
Can you see? And can you see how they balance this account? When you balance an account, the bigger side will minus the smaller side. So meaning if we've got a debit balance, there were more money coming in compared to the payments that the business has made.
That the business made, yes.
So for the end of the month, there was 150,000 that came in. Can you see 150,000 came in? And then tools and equipment was bought for 1,200. Telephone expense was paid for 1,200. And salaries was paid for 6,000. Then the balance at the end of the month was 141,600.
Okay.
And then capital account, I think we saw from the last.
Nothing changed there.
Yeah, and the tools and equipment, nothing changed. Remember?
Yes.
And big builders, it's also the same.
The same.
Long-term loan, 50,000 is also the same. And then let's look at M Beauty, the data. There was a data called M Beauty. So M Beauty here, let's look at M Beauty. So M Beauty is the data, and just look, I want you to look at the side. Which side is this on the general ledger, M Beauty, the data?
It's on the debit side.
And where is it? Can you see? It's also debit on the trial balance.
Yes, on the trial balance, yes.
So if you're looking at the general ledger and the balance is on the debit side, you will take it to the trial balance also to the debit side. When the balance is on the credit side on the general ledger, you will take it to the credit side of the trial balance. Okay, let's look at the service rendered of 80,000. So 80,000, there was service rendered.
There was 60,000 for cash and 20,000 on credit.
Yes, yes. Can you see what makes up that 80,000? It's the 60,000 cash and the 20,000 on credit, which makes it 80,000. Can you see that it's on the credit side of the general ledger and also credit side on the trial balance. Also credit side on the trial balance. So let's look at the telephone account. The telephone account. From the general ledger, can you see that the telephone account is debited with 1,200?
Yes.
And when you look at the trial balance, the telephone is being debited with 1,200.
Yes.
And then when you look at salaries, salaries has been debited with 6,000. And on the trial balance is also being debited with 6,000. And when you add up this, remember what I said, your trial balance must always balance.
Balance.
Your trial balance must always balance. Bank is a asset. And what type of asset? Current asset. Capital is equity. Tools and equipment is an asset. What type of asset? It's non-current asset. Big builders, it's a liability. What type of liability? Current liability. Long-term loan, it's a liability. What type of liability? Non-current liability.
Non-current.
M-Beauty is an asset. What type of asset? It's a current asset. This is income, this is expense, and this is an expense. And then profit or loss account. If Mr. Bingolo wants to determine after one, so before we do this profit and loss account, when looking at this, did the company make a profit or loss? Just looking at the TB. Looking at the TB, can you tell me if the company has made a profit or loss? How do you determine if a company has made a profit or loss? Income minus expenses.
Oh, okay. Income minus expenses. Income is 80,000, expenses is 6 years. Okay. You'd have made a profit.
Yes, because why? 8,000 minus 1,002 minus 6,000. How much is it? So how much profit did the company make?
What is that? 7,200. 7 to 800. I don't know.
Yes.
Yes, 72,800. Where do we get the 72,800? 80,000 minus 1,200 minus 6,000. And that will give you 72,000. So it's 80,000 minus 1,200 minus 6,000. It'll give you 72,800 profit. So they say here at the end of the financial period, all expenses or losses account and income or profit or loss account of a service entity must be closed off to a profit and loss account, which forms the basis for the preparation of statement of profit and loss and other income. So basically what is happening now is profit and loss account, all the income and expenses are being transferred to a profit and loss account to determine if a company has made a profit or loss. So this is an income account. So basically now they're closing this expense, taking this balance to the profit and loss account. So service rendered is being debited with 80,000 and a profit and loss account is being credited with 80,000. Are you with me? So A profit and loss account is created to determine if a company has made a profit or loss. So in this case, they're gonna take all the expenses, the individual income and expenses account, and take the balances out of the individual income and expenses account and put them in the profit and loss account. So in this account here, the service account had a credit balance of 80,000. So they debiting this with 80,000 to clear this account. So so remember, for every debit there must be a credit. So if this account is being debited with 80,000, where is the credit going? The credit is going here. It's going to this account.
Okay.
So basically what they're doing is they are closing off the individual income and expenses account. So after this, can you see that the service account, there's nothing. There's nothing because they've taken this balance out of this to be credited. Can you see profit and loss account to be credited with 80,000? The profit and loss account is credited with 80,000. This is done to adhere to the double entry principle. So this account no longer is closed off, but now the profit and loss account is being credited with 80,000. So let's look at the telephone account. Telephone account had a debit balance. To close off something that had a debit balance, you have to credit that. So it was credited with 1,200. So where is the debit now going? To the profit and loss account.
Profit and loss.
Can you see? It's debited with 1,200. So this individual telephone account has been closed.
Okay.
And then when you look at the salaries had a debit balance. So if you want to close off an account with a debit balance, you want to credit it with 6,000. So this debit now is going to profit and loss. So the profit and loss is used to determine if the company has made a profit or loss. So in this case, the income was 80,000 minus 1,200 for telephone minus salaries. How much is the profit?
72,800.
And I think, didn't we calculate it there? Looking
yes.
Look here. I think we did calculate that. Looking at the trial balance.
Yes.
Can you see? So to calculate the profit or loss for the month, the same as calculating the balance countdown. It's the same as when you're balancing the account. So the bigger side, which is the credit side, you'll minus the smaller side, which is the debit side, minus 1,002 minus 6,000 to get you a balance, a profit of 72,800. An entity makes a profit when the income it has earned is more than the expenditure it has incurred in generating or producing that income. BS Electrical has made a profit for the month because the income earned, which is 80,000, is more than the expense incurred in generating the income. So 1,200 plus 6,000 is the total expenses of 7,200. The income earned is 80,000. The profit is 80,000 minus 7,200, which is 72,800. So this is the statement of profit and loss and other comprehensive income. Service rendered. Where do they get the service rendered? Comes from the trial balance. So this is the statement of profit and loss and other comprehensive income for the month of January. So looking at this trial balance, this is where they got the balances to generate that statement of comprehensive income. So they've used these balances here from the trial balance to generate that statement of profit and loss and other comprehensive income. So this is the statement. This will show the performance of the company. So this is showing the performance of the company. So service rendered, can you see? This comes from the trial balance. The expenses comes from the trial balance. At the end, it will give you a profit of 72,800. And then now, this is the statement of financial position. From the trial balance, can you see where they get the 8,200? Let me just screenshot this trial balance. So all the figures that are there in your statement of financial position comes from this trial balance here. So all the figures here comes from your trial balance. Tools and equipment. Let's look at tools and equipment. Tools and equipment, 8,200. Can you see comes from your trial balance? Data's control, M-Beauty, that's your data, 20,000. Bank account, here it is, 141,600 from the trial balance. And then when you go down here, where do they get the capital of 112,800? Where is the 112,800 coming from? So you will 11200 comes from the general ledger. Let's see the split of that. Can you see where the 112 is coming from?
Oh, okay.
Can you see where the 112,800 is coming from? So is that contribution, capital contribution 40,000 plus the profit or loss. The profit in this case is a profit for the month of 72,800. That will give you that 112,800. And the 50,000 is that long-term loan, Unibank, and the 7,000, remember, is that big builders, creditor.
Yes.
So can you see that your statement of financial position needs to also balance?
Yes.
And that's that for learning unit 2 and 3. So now you're able to do statement of financial position and your statement of profit and loss and other comprehensive income. So we are done for today. How was it? How was the class?
The class was very informative. Looking forward to next week.